So I'm going to talk a little bit about some research that I've been working on, and I'm going to present kind of one finished paper and then also some of the additional stuff I've been thinking about. Most of this, basically all of this, is work I do jointly with my co-author Atif Mian, and we've also been working with a PhD student at Princeton named Emil Werner, so I just want to give them credit right away because they're also researchers on all of this agenda. So, from the very first time I started really thinking seriously about research when I was a PhD student, 15 years ago now, I was always interested in this joint kind of issue, and that is, how does finance interact with the macroeconomy? That's kind of the focus of how I even teach my MBA course. I teach the PhD course I teach. I think it's the issue that to me is most interesting, because economists generally think of these as two different spheres. When we think of macroeconomics, we think of what we call the real economy. And what I mean by that are things like GDP, household spending, employment, investment. Those are kinds of the things that we think ultimately matter, at least partially, for welfare, for the well-being of people, right? Finance in and of itself is not really about those things. It's about how we transfer resources, financial resources, from some people in the economy to others. And so when we talk about the financial sector, what we mean are things like banks, mortgages, bonds, stock markets. These are claims on cash flows, but they're not directly, at least, affecting the real economy, okay? And so there's always been this fascinating question to me, and that is, what is the interaction of these two? How does finance itself, or the financial sector, interact with the real economy? And a lot of my original thesis work was in corporate finance. It was thinking about how different types of financial contracts affect investment of companies. So that was linking the way companies finance themselves to the way they invest. So that was that linkage. And then as I moved on, especially when I started working with Atif Mian, we started thinking more about this from the household side. And that is, how does it change spending, employment, investment patterns if people, for example, have a lot of mortgage debt and house prices fall all of a sudden? So those are the kinds of questions generally that I'm very interested in, and I've been working on. Basically, that's the one theme you can see through basically all the research I've written over the last 10, 12 years. And the recent research I've been doing, which I'm going to talk about today, basically has three main themes or arguments. One is that credit supply shocks matter a lot for economic fluctuations. So let me define what I mean by credit supply shocks. Generally, and again, we're still kind of forming what we exactly mean about these terms, but in layman's term, I would say a credit supply shock is when the financial sector, for reasons unrelated to the actual underlying performance of companies or the income of households, decides to lend either more or less to those households. So again, the idea is that for some reason, the financial sector decides all of a sudden, we can talk about why, what the underlying shock may be, they decide to lend more, okay? People in asset pricing have been thinking about this question as the time-varying risk premium, so that's some of the arguments my students here have heard me talk about a lot. Other people will call this credit market sentiment. Why all of a sudden do the interest rates charged to risky borrowers go down? Okay? But that's what I mean by a credit supply shock, and that's not the traditional approach in macroeconomics. The traditional approach in macroeconomics has been that the source of economic fluctuations is what are called technology shocks. Shocks to the productive capacity of the economy. Think about all of a sudden companies become better at producing goods for a certain amount of capital and labor they employ. That's been the traditional way people have thought of that. And we are taking an alternative route here. We're saying, look, we think that the evidence is more consistent with what drives economic fluctuations. It's not so much coming from the technology side, but instead is coming from the financial sector side. Further, what we're showing in our research is that these shocks tend to work through the household sector as opposed to the firm sector. And that's kind of a surprising result, because most of the modeling that is thought about this credit supply side For example, the very influential research of Ben Bernanke on the Great Depression, where he argues that a negative shock to basically the ability of banks to intermediate credit, what I would call a negative credit supply shock, was a big reason for the Great Depression. It is emphasized mostly firms. And so the argument is, okay, good times are when firms are able to get the financing they need for investment, and bad times is when banks basically pull back on credit and firms can't invest, they can't employ workers. Our argument is that the firm channel is actually secondary to the household channel, that the household channel seems to be what's driving these economic fluctuations. So all of a sudden, subprime mortgages become available in 2004, 5, and 6, and that in some sense then leads to house prices going up, which then leads to a lot of people borrowing against their homes to buy things, which provides a boost to economic activity. So you can see kind of the difference in the way we're thinking about it relative to the traditional channels. And then finally, we argue that these shocks amplify the business cycle, so that the fundamental shocks may be something like technology shocks. They may be shocks to other things, but the financial side actually acts, at least in the short run, as an amplification. It kind of amplifies the good shock, makes the boom bigger than it otherwise would be, and it exacerbates the downturn when things start to turn south. So I want to be very clear from the beginning of the talk. We're not saying that finance is bad or it's evil or anything. We're just saying that at least in the business cycle sense, it seems to be amplifying these business cycles, even though in the long run it may be great, right? In the long run it may be great to have a better financial sector, a bigger financial sector for intermediating credit. Our work is really on this kind of medium run. Let me tell you why this is so important. This is work by Yorda et al., who did this very nice research on 17 advanced countries, taking them all the way back to 1870. And this is just the total ratio of bank lending to GDP, so how many loans are being made by banks, for both non-mortgage and mortgage lending. And what you can see over the last 20 to 30 years, this picture, as you see, goes all the way back to 1870. That's what's very nice about this data they've collected. And what you can see from this picture is that there's been this dramatic relative rise in mortgage lending over the last 40 years. Okay? To the degree that now mortgage lending as a ratio of GDP is far above non-mortgage lending. And when I say household debt, I'm including, of course, mortgage lending. That's the biggest part of it. And so it kind of begs the question, what's going on? Like, what's changed? Why are banks making so many loans against real estate today relative to the past? It also leads to, our traditional models of banking are usually about, they invest, they kind of monitor and examine firms, but that doesn't seem to be a lot of what banks are doing. They seem to be switching a lot more to being lending against real estate directly. So let me talk a little bit about this research paper that's completed, more or less done. And what we basically show in this paper is that sudden large increases in household debt in a given country, the sample is 40 countries over the last 40 years, so it's a big sample of mostly advanced countries, but we have some emerging economies like Thailand and Turkey and Korea we have in there. That sudden large increases in household debt systematically predict a subsequent decline in growth. Okay, so the timing here is if household debt in a country all of a sudden goes up over like 3 to 4 year period, that actually systematically predicts lower economic growth in the subsequent 3 to 4 years. So if you want to think about the US, there was a dramatic rise in household debt between about 2003 to 2007, and we all know what happened after, right? So that's the kind of timing that we're thinking about this. In particular, these increases in debt are associated with consumption booms and an increase in the imports of consumption goods from overseas. This is especially true in emerging markets. Those of you who may follow Latin America, if you think about where Brazil is today, Brazil from 2009 to 2011 saw a massive household debt boom, a huge import of durable goods, especially autos. So that's the kind of thing to keep in mind. And then they went through some pretty difficult times after that. We find that these household debt booms are associated with very low interest rate environments. Okay, so that's kind of why we think that this is a credit supply shock. You could tell a story where, household debt goes up because households want more credit, they believe house prices are going to go up. That's fine, all of that could be true, but it has to be the case that the financial sector seems to be expanding credit. Otherwise, interest rates would go up, not down. Okay, if all of a sudden households all want to get more mortgages and the banks banks don't change their beliefs at all, you're going to see higher interest rates, not lower interest rates. And so that's one of the points we make. we suggest that there is maybe perhaps a role of flawed expectations formation, because as I'll show you, what the research shows is that economic forecasters systematically overpredict GDP growth at the end of these booms. So we can take a factor, that is the increase in household debt over the last 3 years, and we can show that that systematically predicts forecasting errors by forecasters at the IMF and the OECD. Okay? So this is a factor they should know, and they should be taking into account in their models, and they're just not. So that suggests that part of what's going on is that during these credit booms, people don't understand that they could end badly, or that on average they end badly. Then we show some evidence on the global debt cycle, which I'll discuss before. Okay, so I don't want to get too technical here, but let me just tell you the basis of kind of some of the findings. So this picture here represents what we call an impulse response function, which is from essentially time series regressions, actually panel regressions, using this big sample of 40 countries over 40 years. So what we do with that is we basically use that and we explore the relationship between 3 variables: GDP, firm debt, and household debt. And the goal of a vector autoregression, which is what produces this, is to kind of just understand what's the dynamic relationship between these 3 variables. Okay? I view it as purely descriptive. I don't think it's a causal, it's not telling you a causal relationship. It's just kind of describing what happens in the data. What this impulse response function represents is, after estimating these models, if I all of a sudden, within this framework and having these estimated coefficients, if I shock household debt in a country, if I say all of a sudden, let's have an increase in household debt, what is going to happen to GDP? That's what this picture is going to show you. Okay? So what happens? If you shock household debt, you see 1, 2, 3, basically a 3 to 4 year rise in GDP. So you see a boom. Okay? GDP growth increases, and that's driven primarily by consumption. Okay? But then what do you see after? You see a reversion. And this is the kind of focus of this paper, that from years 3 to year 7, you basically see a recession. You see that growth falls. In fact, growth falls so much that by the end of the period, you're at a lower GDP than you were when you started. Now, I want to emphasize, this latter result of ending up at a lower point is not really the focus and is not so robust. So for example, if you took out the Great Recession, you wouldn't get that lower long-run effect. But what is incredibly robust is this medium-run decline. Okay, that's not just about the Great Recession. I can even do this regression excluding everything up after 2006, and I'll find the same result. That's important because, you know, I follow this stuff so much I think it's common knowledge, but it's pretty well shown that the Great Recession was more severe in countries that had bigger rises in household debt. So we kind of know for the Great Recession that household debt is a big predictor of recessions for that recession. Okay, but I'm saying this is true even in the past. It wasn't just the Great Recession driving this relationship. Here's a scatter plot which can kind of give you a sense of just the reduced form relationship, just the basic core relationship. What I have on this x-axis here, the horizontal axis, is the change in the household debt to GDP ratio from 4 years ago to last year. Okay? And then what I have on the vertical axis is GDP growth from this year to 3 years going forward. Okay? So I'm asking for every country year in my sample, how is the household debt to GDP ratio change from 4 years ago to last year related to growth from this year going forward? And what you see in the scatter plot when you run a regression, which is what this line is you see a negative relation, and it's quite statistically powerful. So some of the usual suspects are on here. I don't know, those of you sitting in the front may squint. You can actually see the little, which countries these are. This is Ireland in 2008. Okay? So anyone that follows this knows, you know, Ireland had this enormous increase in household debt between 2003 and 2006, primarily driven by a housing boom. And then they saw a really severe recession, right? Greece, which of course is in the news all the time, is down here, 2007, 2008, okay? So these are countries that had big rises in household debt, sharp declines in GDP growth. But what I want to emphasize is that this is not just about those usual suspects in the Great Recession. For example, here's Norway in 1988. I don't know if we have any Scandinavians in the audience, but it's pretty well known that in the late 1980s, the Scandinavian countries, Sweden, Norway, Finland in particular, had big increases in household debt and then subsequently lower GDP growth. People generally refer to this as a banking crisis, but it's important to note, that to me is almost an outcome. The banks got in trouble because they were lending too much to the households, then the households started defaulting, then you get a banking crisis. So what we argue in this, and that's kind of what I was hinting at the beginning, is that this research and these results seem most consistent with the notion that these shocks are being driven by credit supply. Okay? And in particular, I want to emphasize this point again because I said it pretty fast. It's pretty common during these booms in household debt that you see interest rates fall. And in particular, spreads of risky debt to riskless debt, they fall during these times. Okay? So those of you who work in corporate finance, one of the common measures we use is something like the interest rate on, say, high yield debt minus the interest rate on investment grade debt. That's a measure of risk, the risk premium we call it in the credit market. That is usually falling during these periods when household debt is going up. Okay? Likewise, other scholars have used the share of debt going to low credit quality individuals or firms. Okay? Some people call this the high yield share. So how much total debt is being originated by high yield firms versus investment grade firms, that also is going up during these booms. Okay? So all of this suggests that the financial sector is playing a role in this. It's not just the households changing their beliefs, because again, if the households alone just got optimistic about house prices, they wanted to borrow more, and the financial sector didn't change, then what has to happen? Interest rates have to go up, if anything, right? I mean, if you hold credit supply fixed and credit demand goes up, interest rates have to go up. So then the question is, where do these come from? Like, where are these household debt shocks coming from? Where are these credit supply shocks coming from? Well, I wish I had a better answer on that right now. And so that's what we're working on now. The emerging market literature has talked about this for a long time. Okay? This is not new in that literature. If there's something new here, it's really more about the advanced economies. The emerging market literature, even, it's usually some argument about the influx of foreign capital. Okay? So you can think about Latin America in the early 1980s. You can think about the East Asian countries in the 90s. There's some shift in what I would call global credit supply or global appetite for risk that leads to money flooding into these countries, and then household debt is where it shows up. Okay? You can also think about deregulation of the financial sector as a potential source of these shocks. Okay? That you all of a sudden allow the financial sector to do more lending, and so then you get an expansion in credit supply. There's also a lot of recent research on behavioral biases in the credit market, what has been known as credit market sentiment. Okay, that's another source. And as I mentioned, the prediction from all of this is that the expansion of debt is associated with low interest rates and increased credit to low credit quality borrowers, which is everything that we basically show in the paper. Then how do you get a downturn? Well, the argument then is eventually people realize they've extended credit too much. Maybe when defaults start creeping up, most people think the subprime mortgage default rate crisis started as a kind of the very last loan that I make is the first loan to default. That's like the classic symptom of a credit boom gone bad. I've extended credit to such a low credit quality borrower that they literally default within 2 months after making the mortgage. Okay? And so you can imagine that's when the whole process reverts. And then we show evidence that things like rigidities on wages and rigidities on prices seem to be at least partially responsible for why, when the demand shock comes, when we pull back all that credit and households no longer can be taking out home equity loans to buy TVs and furniture, why does that lead to an economic downturn? Because prices have a hard time adjusting, wages have a hard time adjusting, and that's what you get at least in the short run. Now, my colleague Eric Hurst has been doing some really interesting work on that these kinds of debt booms may also distort the real economy in a way that's not just about short-run frictions. For example, he shows that a bunch of people stop going to community colleges during these booms and they start working in construction and retail. Okay? That has devastating long-term consequences because when the debt boom ends, they tend to not go back to school. Okay? So you can argue that that's foregone human capital accumulation because of the debt boom. A lot of people say that's what happened in Spain during the recent boom. A lot of people dropped out of high school, dropped out of college to go work in construction, and when the boom ended, they'll end up being less educated and therefore less productive. This result is actually strong enough to generate what I call a global household debt cycle. So our analysis so far that I've described is really about specific countries, right? So this country has a big decline or a big increase in household debt and therefore sees a big decline in subsequent GDP. But what we started showing, and this is how we kind of came to this, is that when you look at the components of GDP after the household debt boom, so the components of GDP are basically consumption, investment, net exports, and government spending. Not much interesting is happening on the government spending, so we don't talk much about that in the paper. But the one margin that seems to be going in the opposite direction is net exports. So after the big boom in household debt, consumption falls dramatically, investment falls dramatically, but net exports actually goes up. And those of you who remember your macro, net exports is exports minus imports. And what really is happening is imports are falling, so net exports kind of mechanically go up. That's exactly what's been happening in Brazil over the last 3 years. I mean, you all of a sudden stop buying imported cars, your net exports are going to go up. So that got us thinking, oh, well, the net export margin helps countries cushion this blow in some sense. But then what happens if everybody goes through it all at the same time, right? If everyone is all going through a big household debt cycle at the same time, and everyone's trying to cut imports simultaneously, well, that obviously affects everyone's exports, and so that margin won't be there. And so we basically find that countries that have their own household debt cycle more correlated with the global household debt cycle, they end up seeing an even worse decline in growth after a boom in household debt, which kind of makes sense. They don't have that net export margin. In particular, a global rise in household debt reduces the scope for exporting out of a downturn. And in particular, recent changes in household debt matter for each country. And it generates what I call a strong household debt cycle. So here is the picture. So here now I'm not using country-specific evidence. I'm just using all the countries. I basically smush them all into one observation for each year. Okay? So it's just a time series plot. Every year on this picture shows you how the global household debt to GDP ratio changed over the last 4 years, and then it shows you subsequent GDP growth on the vertical axis. So the usual suspects are out here. I think this is pretty well known at this point, that there was this massive increase in global household debt between 2004 to 2006 and 7, and then that led to a decline in global GDP growth. Okay, that's the kind of world global recession. What's not so well known is that if I take out these observations, the regression line actually looks identical, meaning that it wasn't a new phenomenon, actually. This magnitude of how big the household debt boom was new. But this is something I'm realizing in my recent research. If we go back and studied a lot of the lessons, actually, of the Great Recession, we could have learned by actually studying the 1980s. But it just wasn't on a scale that was large enough that I think people really understood. But it's basically the 1980s looked like a mini 2000s. From 1982 to 1989, there's a sharp increase in household debt in the US, driven by credit supply, and then you see a severe recession. The same thing is happening in a lot of countries. There, I think you can make a more direct connection to financial deregulation, okay, in the 1980s in particular. So what are some other examples? And then I'll wrap up and take questions. So we've been looking at this, and all of this is at this point pretty anecdotal. At that point, I don't think we've done enough serious research to back the claims that I'm about to show you, but I think it's an interesting idea. Michael Pettis, who's an economist that works in China and has been thinking a lot about China recently, in one of his recent articles, he had this quote which got me fascinated, and I've started to read a lot more about the Latin American debt crisis. It's amazing how much we can learn from that episode. He basically says, in early 1970s, as a newly assertive OPEC drove up oil prices and deposited their massive surplus earnings in international banks, these banks were forced to find borrowers to whom they could recycle flows. They turned to a group of middle-income developing countries, including much of Latin America. Okay? So his story, which is fascinating, actually, and I'm starting to buy into a little bit, probably more than I should. I should first look at the data. But his story is that when we talk about things like the current account deficit and trade balances, that we should actually think of the flip side, which is the capital account imbalances, and that those are really the fundamental driver of things. That the reason the U.S., having trade restrictions against Mexico makes no sense because both Mexico and the U.S. are running a trade deficit with the rest of the world. And the reason they're running a trade deficit with the rest of the world is not because of anything on the goods market. It's because China essentially is exporting so much capital overseas, and so it has to show up somewhere. So in some sense, he's focused on the financial side and saying that the flows on the financial side are really what's dictating a lot of what's going on the real side. And again, I think people aren't used to thinking like that. They're usually thinking the real economy moves first and finance follows it. But we're making the argument that maybe it's going the other way around. Financial deregulation in Scandinavia in the mid to late 1980s. There this quote is from a survey of that episode. The boom-bust process there starts with deregulation of financial markets, leading to a rapid inflow of capital to finance domestic investments and consumption. So again, this is the kind of story that we're trying to tell. In new research that we're hopefully going to be able to make publicly available within the months, we're testing this hypothesis in the banking sector in the United States in the 1980s. And in particular, state laws were deregulated at a much different frequency in the 1980s. And we can kind of use that variation to see whether states that deregulated their financial sectors earlier had bigger booms and bigger busts in that cycle. So again, the argument here is there's some aggregate credit cycle going on, and there's a boom-bust phenomenon happening more in the states that deregulate their financial sector earlier. So these pictures are really preliminary, so let me just kind of try to explain them. Think of this as, 25 states which deregulate very early versus 25 states that don't deregulate until like 1989-90. And then I'm showing you the relative boom and bust in house prices, unemployment, real GDP per capita, and residential investments. So this represents the difference between the early deregulation states and the late deregulation states. And so what you see is this very striking boom-bust pattern, that especially in house prices go up a lot more in states that deregulated their banking sectors early, and then you see a crash. And here on residential investment, you see again this boom-bust phenomenon. Okay? You see it in unemployment too. Unemployment goes down and then goes back up. So this is very preliminary research, but again, the argument we're trying to make here is that the business cycle ends up getting amplified because of this easier credit supply. So let me wrap up. So fluctuations in credit supply working through the household sector seem to be an important source of economic fluctuations. We argue that shifts in credit supply tend to amplify the business cycle, leading to severe boom-bust episodes in some circumstances. But I want to be careful to avoid normative statements. Economic growth in the long run may be higher because of shifts in credit supply, even if it generates more volatility. And I'll give you an anecdote that one of our discussants showed, which I thought was very nice. So he showed two pictures of growth in Thailand and India. And those of you who work in emerging markets may know, Thailand has a reputation for being a bit like the Wild West in terms of its financial markets, whereas India is a really heavy regulated system. Okay? And what he basically shows is exactly our phenomenon, that Thailand goes like this, right, in terms of its GDP, and India goes like this, but the average growth rate is much higher in Thailand versus India. Okay? So that's an anecdote. I don't think people have taken that seriously and really estimated if that's the case. But you can imagine that's easily true. That what we're showing you in our work is that the business cycles tend to vary more, but overall, the average GDP growth is higher in the areas where the credit supply kind of moves more dramatically. I will say, though, that the Great Recession has got people questioning that. In particular, one of my colleagues and some others, you see an increasing amount of research saying that economic growth, even in the long run, may be lower if these booms caused by the financial sector distort human capital, for example, or the industry mix. Okay, so you can imagine what happens. That's some of what we're showing in our new work. In these states that deregulate early, what kind of industries do you think expand in terms of employment? Retail, construction. What kind of industries are stagnant? Tradable goods, exporting. So you can imagine that that's partially what's been going on in the US over the last 20 years, right? That we've been focusing on retail and construction because we've had these housing booms, and that leads the tradable part of the economy, the exporting part of the economy, weaker. Again, that's not my research, and I still think the evidence still needs to be shown, but that's basically where people are starting to head. The big open question I still think is, what is the source of these credit supply shocks? Like, why do they come? I think there's a general argument you hear, something about financial excesses. So the Latin America example I like because it's very clean in that sense. that you know exactly what happened, these OPEC countries. Now that, of course, means somebody else is paying a lot of money to those OPEC countries, so it should offset in some sense. So it's still an open question. Maybe it's related to monetary policy. People have argued that wealth inequality, because the rich, when they get richer, put more money into the financial system, so then you have the credit supply shock. But I think we're still pretty far from figuring that out. But I think that we're making progress, so hopefully people can start to try to answer that question. And I'm happy to take questions. Thanks a lot for listening.
I remember the dot-com recession of the early aughts. And by the name I'm giving it, it wasn't related to household credit, or at least it seems that way. Are you saying, is your paper saying that it is, or that element was there?
No, I want to be clear that we're not trying to say this is the only source of recessions, for sure. I will add that was almost not really a recession. In terms of if you look at the magnitude of that recession, it's far smaller than 80, 82, or 90, 91, or the Great Recession for sure. But yeah, I think that is a very different recession than these other three, and from most of the recessions we're talking about. That's primarily focused, I think, on capital investment fueled by equity, not debt. And so, it's a different animal. Totally agree with that.
So when you showed the one chart where it's consolidated just the calendar years going back over time, it shows and you mentioned that the order of magnitude sort of explodes with the most recent financial crisis. In the United States, how much of that was due to subprime? So you talked about high yield share earlier. Home ownership's rate going from 63% to 69%. How much of that was driving the magnitude here?
So, that channel of what I would call the extensive margin of subprime mortgages allowing people that previously weren't able to get mortgages to buy a home, I think that's an incredibly important part of kind of triggering what happened. But in terms of explaining the aggregate rise in debt, it's not that large. And that reason is because, like you said, 63% of the people already owned homes. So the channel that really matters is, at least we argue, that if the fundamental shock is credit supply, that ultimately then pushes up house prices, right? Because anyone who's bought a home knows this, right? What is the broker going to tell you? They say, what interest rate can what monthly payment can you afford? Well, if interest rates are lower and it's easier to get credit, then the monthly payment for a given price that you'll be able to afford will be lower. So you basically are saying, I'll buy a bigger house, or I'll buy a more expensive house. So the real thing that explains the aggregate rise in debt is then existing homeowners turning around and borrowing against home equity. That's really the thing by far that explains the magnitude. And that was disproportionately strong among low credit quality individuals. So it's not, I wouldn't say that that's not exactly subprime. But even prime individuals, people all the way up to the 85th percentile of the credit score distribution, they responded quite aggressively to that higher house prices by borrowing aggressively. It's very interesting. The people at the top 10% of the credit score distribution who are homeowners are almost completely unresponsive. They do not go out and do a cash out refi or increase home equity when their house price goes up. So I think when we're thinking about, which borrowing increased the most, the subprime stuff was important for getting the whole thing going, I think, but it was really everyone, more or less, except for the very top of the credit score distribution, borrowing against their homes.
Hi, so in your presentation you mentioned India versus Thailand, and one had more boom bust and one less because of more regulation. So from those findings, how do you think you can inform our current discussions in the United States about further deregulation of the financial sector, like Dodd-Frank?
Yeah, so, I think there's these short run and long run effects that have to be kind of carefully considered. And I think that what I hope our research is doing is just, when you read the traditional economics literature on financial deregulation, they're telling a very specific story, which is we need to improve the allocation of capital to firms. That's really the story they're telling about how you get better growth. So there's some firm out there that desperately needs capital. They're small, they're really productive, they have a great product, we all want to buy it, but they don't have the capital to buy it. Okay? That's the traditional argument that financial deregulation has had. I think our research, our new project is really showing that that doesn't look like what's going on. It looks like what actually happens is that, at least in the short run, it tends to work through the household sector, through more mortgage lending, through more credit card lending. And you could tell the argument that that improves consumption smoothing, or you could tell that improves household insurance provision, or you could tell the story that that just boosts household spending in a way that might be dangerous if households have behavioral biases. And so my worry in the current environment is that are we just trying to deregulate the financial sector in order to get them to boost household lending more, or not? Now, I want to be careful. There's a lot of people that argue that household lending is too tight, that restrictions on household lending are too tight, and I think I have some sympathy for that view as someone who's done a couple of refis over the last 2 years. Like, it is kind of remarkable now how much you have to show in the documentation. So I think there's some of that. But I think that we at least, I'm not saying the firm story is completely wrong in the US, but at some point, we need to ask ourselves the question, in a country like the US with this advanced of a financial system, do we really think there's a ton of firms out there that can't get a loan and that's why they're not expanding? Maybe. But I don't know if that channel's that big, at least in the US. I think when we're talking about emerging economies, it's a different picture. I think the emerging economies, there's a credible story to say, look, India needs to have financial deregulation because there's small firms that are starving for capital. I think that story makes sense for me for India. It's not obvious it makes sense for me for the US.
Is there a difference in your series of mortgage debt versus non-mortgage debt for a country like Canada where there are less tax advantages for people holding mortgages?
Yeah, although, as you know, Canada's had a huge boom in mortgage debt now. I think the tax benefit is important, but I think that, it's not so important that it would lead to materially different patterns. But I haven't looked at it, to be honest. It's a very good question. I think in the US, when the interest deduction originally did lead to people switching from borrowing on credit cards to borrowing on their households. So I think that, on their home, so that is an important channel.
Should the credit shocks should be prevented, and if so, how?
Oh gosh, that's way beyond my pay grade. I don't know if they can be prevented. I don't even know what the source of them are. So I don't know if it's even feasible. I think the normative implications we make in our book are not so much about these credit supply shocks, but about financial structure, which takes me back to my roots as a corporate finance person, which is really what I am at the end of the day. And that is, I believe that the financial product of debt itself is part of the reasons you get these amplifications. And to the degree that the government very actively promotes the use of that contract, I think that that's a really bad decision. I don't understand why the government does it. They give the mortgage interest deduction. They basically penalize banks for having claims that look too much like equity when they lend. So that's something I think is part of there. And so let me just explain that intuition, because it's not so obvious. But I think debt has this ability to fuel asset price bubbles because of the nature of the contract. And it basically leads to a situation in which people who are not so optimistic about house prices, for example, may be willing to lend to people who are very optimistic about house prices because they feel safe, because I have the senior claim. So if house prices fall, as long as they don't fall by much, I'm fine. And so you get this shift. This is basically the work by John Giannakopoulos at Yale. I think I really buy into. You get this shift of buying power from more pessimistic people to more optimistic people, which I think tends to fuel these booms. And this is an old idea. Charles Kindleberger, the MIT economist, he talked about this all the time, that one of the primary features of asset price bubbles is that they are fueled by some new financial product that makes the lenders feel they have something as safe as money. And he wrote that in 1982, and you can see subprime AAA mortgage-backed securities. It's exactly what he was talking about. So I think there's something about debt specifically that we need to think about.
You haven't mentioned this, so I guess it isn't important. But at this time, weren't the banks securitizing these mortgages, selling them around the world, getting those loans off there, and continuing to do that because it was just a wonderful thing to do?
Yeah, that's a great point, and I should maybe be more fair and say, on this slide, when I talk about the sources, I should just say, fraud as one of them. And, I have research on that, for sure. I have research showing that there was a lot of fraudulent practices going on associated with securitization. I guess at the end of the day, I think of the bank. I think I am convinced by the behavioral economists that the fraud would not have been possible unless someone had some incorrect beliefs somewhere, right? Someone was willing to buy into the story, so that you need a combination of it. It's both. You need the fraud, and I think you need the beliefs to be changing as well. Because the way the fraud works at the end of the day is you basically say, I think this is kind of fishy what they're doing, but as long as house prices keep going up, who cares, right? So it's a combination of the both. So I don't mean to absolve, and certainly anyone that knows my research well will know I do not absolve the financial sector for the stuff they did from 2002 to 2006, and that's a very important part of the story. So I should have it here as one of the potential causes of these credit supply shocks.
Right. So, I mean, on one hand, right, you're saying, okay, in the long run, we would expect that the financial sector and credit markets do a really good job at.
I didn't say that. I said that could be the case. I don't know.
Right, but I think it's fair to say that this is broadly probably still the consensus, right? On the other hand, you're saying, okay, if you have these problems in the medium term, that could very well lead, as also your colleague Eric has shown, lead to problems in the long run, precisely because you might have some allocative inefficiency, right? Even in firm outcomes, as you were saying. Think about Spain and construction workers, right? So what's your hunch about what's there?
I think I would split it in between advanced economies and emerging economies. I think my hunch is for emerging economies, the traditional notion is correct, that fine, you get more booms and busts in Thailand, but in the long run, you get better capital allocation. And I think in advanced economies, again, I think I'm increasingly skeptical of this idea that capital is massively misallocated across firms. And so when you see the financial sector growing rapidly, you have to think about what exactly is it that they're doing. And I think it's like one of these things that I think about a lot, that when you have an economy that is incredibly efficient and fluid, I think most of us at the University of Chicago think that's a good thing. Like, economies should be very flexible. They should be able to react. But the problem in that kind of situation is if something gets distorted, everyone moves so fast and takes advantage of the distortion, right? You see this in construction and with the financial sector. And so it's like you say, I think I do have a hunch that this misallocation point is quite important. I know Eric, for example, maybe he doesn't want me saying this, I guess it's on camera too, but I know he's doing research thinking very seriously about the allocation of talent from elite undergraduate institutions into finance from 2002 to 2006 away from sciences, for example. That's an interesting question. I think that my hunch is that prior to 1980, the advanced countries probably looked more like emerging countries, but today, when I see these big booms in credit, it's hard for me to imagine that there's even long-run good consequences of that. I don't.
Could it be that volatility in advanced economies is becoming just a bad thing long term because of how much time people must spend developing their human capital? 100 years ago, there could be a construction boom. Doesn't matter. They're going to go into the next job the next day, or the next year as soon as the economy returns. They can't do that now. If you haven't spent that 4 years or 5 years in an undergraduate institution, you're shut out of the economy in a lot of ways. Could it be that we need to start making that trade, pulling away from volatility to start guaranteeing even just slow growth?
Wow, that's a hard question. I think there's a lot of stuff mixed up in that question in the sense that there's these long-term secular trends that we know about employment and middling out and the disappearance of these kinds of other jobs. How does that, I guess you're asking, how does that longer-term secular trend interact with these boom-bust cycles? Yeah, I don't know. I have to think about it. Honestly, I don't have a good way of trying to conceptually link those two things. I think one thing I will say that's just a fact that I find quite fascinating is whenever you see these long-run secular trend pictures, so for example, a common picture many of you may have seen in a newspaper is the decline in manufacturing employment as a fraction of total employment in the U.S. I'm an economist, so I've seen it. I won't say we all have seen it, but people have seen that picture, right? It accelerates in downturns. It's kind of very interesting that you see this decline and then it accelerates every recession. So that's where I would start in thinking about the answer to that question that you just gave, but I'd have to think a little bit about it more. That somehow these big shocks end up being more costly in this world in which secular trends are leading to it being harder to get a job if you don't have human capital. So I have to think about it a little bit.
We see regulation supposedly is going to loosen up recently, and similar to what happened in the 80s, what happened in early 2000. And other than that, we have similar monetary policy with easy credits has been going on for an extended period of time.
Yeah.
And then we have the price of housing. Right now it's going back to 2006 level.
Yeah.
And then on the financial market, you said the risk premium is declining, exactly what we are seeing today. S&P is all-time high right now. And then word on the street, everyone is trying to overplay risk assets. Are we in a perfect storm again?
Well, one of the things I always look at when I try to think about these predictive type comments, which are always very hard to do, is it seems to me that the booms that end badly are the booms that distort the real economy in some way. It's something you can point to and say, this easy credit is causing this in the real economy. So from 2002 to 2006, it was very easy to know. I mean, if you look at the fraction of total retail sales that was in furniture, appliances, and electronics, it's stunning. I mean, it just goes up dramatically during those 4 years. So there's some way you can see, okay, people are borrowing against their homes, and they're buying like a lot of goods. So that's kind of what I look for when I try to think, oh, is there some like real effect of this credit boom? And I'll be honest, in the current environment, other than in the auto loan sector, I would say, like in subprime auto loans, I don't see so much obvious distortion of real economic activity. What I see is a bunch of companies refinancing their debt like every other month to take advantage of low interest rates. But they're not really investing, and they're not hiring workers to a large degree. And so I'm not saying there won't be a crash. I'm just saying if you think about the real economic effects of such a crash, I mean, the cynical view, maybe the optimistic view is, okay, there's a crash in high yield bond prices. Okay, so some rich people lose some money, right? But like, is it going to really affect the real economy in a dramatic way? I don't know. I think we sometimes think, oh, anytime there's going to be a drop in asset prices, it's going to hurt the real economy. But I'm not so sure that I see that channel this time. I could be wrong. It's always, dangerous to make such a statement. Now, if you're asking about asset prices, I'm not going to try to do that. But I will tell you there are these pretty strong predictive relationships. Strong, I don't know how statistic, Lars probably wouldn't believe that whether they're statistically significant or not, I don't know. But that when the credit risk premium is really low, it tends to predict a decline in asset prices over the next 2 or 3 years. Now, those models have been blown out of the water for the last 8 years. Now, many people will say that's because of the Fed. Because the risk premium has been low now since, 2011, really low. So, in credit markets, so.
Do you think with the Great Recession and what's happened, your model is going to be as predictive of what's going to happen in the future because of the increased scrutiny on household debt and so on?
Yeah, no, I mean, that's a great question. I don't know. I mean, I know that the Bank of International Settlements, which is kind of the central bank of the central banks, and they put together the regulations for global national banks, and they try to coordinate the global banks, which they're very upset with the current administration because they're saying they're going to undercut all of the stuff they've done. I know they have zeroed in on household debt hugely, and they, in some sense, we kind of the story we're telling in our book, and they've been saying for 30 years. I mean, there have been economists there since the 1980s, pointing this out. So we'll see. I mean, I think it's a great question. I think that the nature of these crises is that they always show up in kind of different manifestations of what they looked like before. But I do think that real estate is the only asset in the economy that's collateralizable enough and owned by households enough that if regulators really focus on real estate lending, then you could imagine less boom-bust kind of stuff going on. I mean, I think I've always been amazed at just watching in Hyde Park, for example, how many new rental buildings are going up. That when I first moved to Hyde Park in 2005, those would have been condo buildings, not rental buildings. So that kind of changes the whole dynamic of the way this stuff works that we're talking about. If 50% of people, this stuff we're talking about doesn't happen in Germany when home ownership rates are low. It doesn't. Just Germany just looks like this. I think that is related to that. All right, well, thank you very much, everyone. Appreciate it.